Okay, and I'll be keeping an eye. Um, I did with this with the last class, just I suppose while people are joining. I'm just going to launch a poll. I'm going to use polls throughout today's class. This is really just really a measure for me to pace the class. So I'm going to use polls. We'll have questions that we're going to work through. Unfortunately, all I can do with the polls is multiple choice questions. It's a little bit limited. But once I put up a poll, if you can attempt to answer it, I'm just asking this one. This is an anonymous poll that I'm putting up just to get a sense of whether people are logging in from computers or mobile phones. And that's just to give you guys an indication, or just to give me an indication if I need to get any other materials out to you before class, because it can be a little bit harder on a mobile phone. But I know not everybody has access to that at home. So just to give me an indication, it's not if I need to be preparing other materials, etc. Okay, I know we weren't expecting to be online. So we mightn't have our notes with us today. I'm going to stick up a link to the e-version of the notes that hopefully it'll be easier, obviously, if you're working on a computer and don't have your notes, that you'll be able to get them. Okay, that's great. Thanks so much. Nearly everyone has voted there. So the majority of people are logging in on a computer or tablet, which is great. That will make life a lot easier in terms of sharing items. Okay, so I'm just going to end that poll now. So if you didn't get a chance to vote, that's okay. I'm just going to end it. It's just kind of a bit of information for me. Also getting you used to answering those polls. Okay, what I'm just putting into the chat now is a link to the manual in Moodle. If it's a case like me, I'm going to have to work from that today because I don't have my paper notes with me. So I will have to do a bit of shuffling between and ticks in between, but we're going to get through that. Okay, so I'm going to get started. Just a quick, I know you guys are probably know more about Zoom than me at this stage. But how can we kind of keep these classes as normal as we can for the next 2 weeks, just to get through the next 2 weeks and to give you the best experience you can. Obviously, we'll just treat it like normal class. If you can have a copy of your notes and questions, it should say there, and your calculator. So like our classes face to face, I'm going to be getting you guys to do a lot of work. I've just put into the chat a link to the e-version of the notes if you don't have those paper notes available. And I'm going to be in the college tomorrow at some stage. I can leave hard copies of the manuals because I know there's still people joining us that maybe haven't been to class yet. So I'm going to leave hard copies of those manuals even in the business departments. If there's people who still haven't managed to get a copy. I'm not sure what the access is like to the college, but I'm hoping to get in tomorrow. Ideally, I'd love people at the start and when we do have chats to turn on your camera, so it's great for me to see just faces and to gauge the class. It's not going to be up for everyone's cup of tea, but I will put up how you can hide your background if you are logging in from shared accommodation or etc. somewhere that you want a bit of privacy. To ask questions. Again, you have emoticons in Zoom. If you raise a hand, I will get a notification and I'll try and keep an eye on the chat as well. If it's a case that you don't want to speak over your mic and ask a question. Just with the questions, if you're typing it in, type it into everyone so that everyone kind of gets the benefit from the learning. Someone else will be thinking the same thing. And I'll keep an eye on those chats as best I can. The online polls, again, I'm going to use these in terms of how we're progressing through the material. Are we getting the key points that we should be? It'll also get our minds thinking about this continuous assessment because we know that's a multiple choice style arrangement. So we'll have a look at the very first thing we're going to do today is have a look at a sample CA question from last year, a nice easy one to ease us in based on what we've looked at so far. So if you could vote on those polls, I'm going to let the polls run to about 60 or 70% of the class have answered, and then I'm going to move on as a way to gauge it. So if it's a case that you haven't got your question answered in the time, don't worry. I'm just doing that because sometimes people go off and have a cup of tea and aren't really at the screen. So I don't want to be kind of sitting around waiting while everyone else has the question answered. So that's why I'm doing it that way. It's not as a way to push you through. It's just like class. And we have our Zoom emoticons. So again, we've started at 3 o'clock today. So I'm going to ask at around 5 to 4 if someone just puts up the coffee sign or gives me a signal to let me know that it's coming up to the hour, and we'll take a 15-minute screen break. So just get up away from the screens, It's raining here where I am, so I'm not going to be going outside to get air, but just to get away from the screens, rest your eyes, and then we can kind of come back at it, and I'll put in a note at that stage. So if someone can remind me that, because I have a tendency to yabber on, and you'll be sitting there at your screen. Okay, so where are we on our course? So topic 1 that we've travelled through, we've looked at the nature and purpose of financial management, and we've looked at those 3 key decisions, the financial management decisions that a finance manager has to take into account. So our FIDO. We've looked at the objectives and in typical of different organizations. So we're mostly predominantly interested in companies that are being set up for a profit and looking at their financial objectives and their non-financial objectives. So what they were, we looked at 2 different types. We talked a little bit about the agency relationship, so that problem between shareholders and the management of our company, and the costs that can arise out of having to manage our shareholders, having to manage our management, because they typically mightn't have the same objectives as we do for our company, and there can be a cost attached to managing those people. We talked a little bit about ethics. Is there ethics in business? Do I think yes? I think in modern day times there is. Our company doesn't exist in a vacuum. And that corporate governance structure, the rules, a set of rules that we set up our company by, that we kind of meet this minimum ethical requirement. So we're into the kind of key or crux of topic 1, our financial analysis. And we had looked at 2 sets of ratios last week. And that's what we're continuing on to today, this financial analysis part here using our ratios. So a CA style question, I'm just going to release this to ye now. And it's a nice simple one for you. We have to, out of the 5 options that we've been given, so in your CA, you're going to have 5 multiple choice questions or 5 multiple choice answers, and we select one. And we have to identify which of the following ratios measures liquidity. So when we talk about liquidity, we talk about that measurement or ability to pay our debts. So out of those 5, which one of these measures liquidity, our ability to pay? So I'm just going to give you a minute to have a read down through the options and select your answer, and then we'll share the results and see how we got on. Okay, so a nice one to start to ease off ourselves into. Okay, great. Nice to see you, Katie. Okay, so I see the votes flying in here. A couple of different answers coming in, so consensus for 1, but let's see. What do we think? Measure liquidity, if I can talk. I get tongue-tied. Our ability to pay our debts as they fall due. Okay, I've over half the class have answered this question now, so I'm just going to give it another half a minute, get the rest of those votes in, and we'll share the results and see how we got on. There was 2 ratios that we came across last week. Oh, great. Yeah, someone, I think, messaged me privately. Maybe you can't vote on the thing. Thank you. I can't see your name. It's your student number, but well, yeah, you have the correct answer. Thank you. Okay, so I'm going to close the poll now. So you won't be able to vote. So I'm going to just end the polling now. About over 80% of the class have answered. And we'll share back the results. Okay, so the poll is now closed. And hopefully now you can see those results that I've shared back for you. Okay, so we have a couple of different answers coming through. Which of the following ratios measures liquidity? So we looked at 2 last week. We looked at 6 ratios altogether, but 2 in particular measured liquidity. Today, we're going to look at gearing. So thankfully, no one answered gearing. That's one of the ratios that we're going to look at today. And if you want to note for yourself, our gearing is a measure of our financial risk. So if we were asked which ratio was a measure of financial risk, there's only 2. One is gearing and the other is interest cover. And we're going to look at what they are today. Okay, so we have a couple of people voted for stock turnover. That is another form of our working capital efficiency. And I can kind of think of the logic of why you might have picked stock turnover, because when we're looking at liquidity, we're looking at our assets and we're looking at our current assets, which are our stock, our debtors, our cash, and we're looking at our current liabilities, and we're looking at how able we are, I suppose, in a sense, to convert those current assets. But really, we say our stock turnover period is more an example of a working capital efficiency ratio. So, how effective or how well are we managing our stocks, our debtors, our cash, our creditors, our working capital? And that's what we're going to go on to look at today. So, that's not one we're going to use. We have a huge consensus coming in for asset test ratio, so that's great. The last two there are return on capital employed and our gross profit margin. So you might remember from last week, these are two forms of our profitability ratios. So a key difference between our liquidity and our profitability is the sales we record, we mightn't have gotten paid for them. The expenses that we record, we mightn't have paid them yet. And so it's a measure of our accounting profit. It does not reflect effectively the cash we receive. It doesn't always reflect the cash we have in and out of our business. So our return on capital employed, again, we use this when we're trying to maybe compare two companies in terms of how effective they are as an investment. And our gross profit margin, again, when we take our cost of sales from our sales, what percentage is left. So those two are more a measure of profitability. So our correct answer is absolutely the asset test ratio. So can we remember from last week, what's the kind of typical result we expect or that we look for when we are calculating an asset test ratio? Our liquidity ratios are kind of two of the ones that we expect certain results. So what do we expect with our asset test ratio?
That would be 1:1.
Yeah, thanks a million. I think that was Mia coming in there.
Yeah.
Thanks, Mia. 1:1, absolutely. Thank you. So we need one asset to every one liability, and that's slightly lower than our other liquidity ratio, our current asset turnover, our current ratio, where we include the value of stock. So with our current ratio, we typically look for 2:1. Our asset test ratio, we can get away with slightly less because we've removed the value of slower moving stocks. So hopefully that's helped explain that question. That's kind of a sample of a very short theory style question with the CA. So we'll come back and we'll have a look at some more, but hopefully that made some sense. Okay, so I'm going to stop sharing that and we're going to go on and we're going to have a look at the three ratios that we're going to, well, there's six that we're going to look at today, all going well. Our working capital efficiency. So we might have seen that stock holding period as an option on our previous question. So what do these three, so have we come across these before in any of our subjects? You can just give a yes or no in your votes. And thanks, Nicola, as well. Have we come across these ratios before, maybe? Yep. Yeah, sorry, I think I hear a yeah coming through. Okay, so I'm going to talk through them and I'm going to show you a short video of how they come through. So it might be just a quick recap. So with our working capital efficiency ratios, we're looking at our current assets and our current liabilities and how effective we are managing them. So the first one there, our debtors credit period. We're looking at our average debtors. And if you want to mark for yourself, in your exam, we will not have enough information to work out average debtors. So we are going to use the debtors figure per the balance sheet. Okay, so if we had all the debtors information for each month, we could work out the average. But for our exam, we are going to take the debtors figure as per the statement of financial position. Okay, so we can kind of ignore the fact that it says average there, is basically what I'm trying to say. Okay, so our debtors, customers who owe us, we're then going to divide it by our credit sales. So the way I explain our credit sales is when our local centre, if we take them and their crates of water that they buy in to sell in the shop, when they buy that from Musgraves or whoever is their largest supplier, they take the crate of water, and typically the supplier will give them maybe 30 days to pay, 30 days being kind of the standard in Ireland. Okay, different countries have kind of different accepted practices. So the Centra shop can then take that crate of water, sell it, but they still have 30 days to pay. So that's a credit sale given time to pay. Now, if you think about the likes of me and you, if we go into our local Centra, I buy the bottle of water, I have to pay for it there and then. That's a cash sale. So people or companies who have cash sales typically, so are dealing with customers, non-business customers, like myself or yourself, who'll be going in and paying straight away. They're cash sales. So those type of businesses don't typically have debtors. So what I want you to note in this is if we are not told otherwise in the question, we assume all sales or all revenue in the accounts are on credit. Okay, so if we are not told otherwise, we assume all sales or revenue in the accounts are on credit or are credit sales. Okay, and most of our questions be like that. Okay. So once we've worked out our debtors divided by our credit sales, we multiply by 365 days. And our answer to this, if you want to put in equals, is always in days. So it's not a percentage, it's not times, it's in days. So what it tells us is, sorry, is someone trying to come in there? Sorry, I thought maybe someone might have been trying to ask a question. It just wasn't very clear. What it is in days. So our debtors credit period will tell us on average how long is it taking our customers to pay us. How long on average is it taking our customers to pay us? And we typically want that to be short. And if it's lengthening out, we might be getting into difficulty. So we might need to look at that. Okay, so that's our debtors credit period. Then our stock holding period, again, it could be called inventory turnover period, inventory holding, inventory, any of those words. Again, we are going to ignore that it says average stock there because for our purposes, we are not going to have enough information on the company. We are going to take our stock figure per our current assets in our balance sheet. We're going to divide then that by cost of sales. So what this stock holding period is, say I'm a producer of those plastic masks. I purchased the plastic that's going to be the front shield of the mask, so an item of stock. And I store that in my warehouse until such time that I'm producing my final mask and it's in a final mask that I can sell to a customer. That stock holding period is measuring how long does that take from the time I purchase the stock to the time that it's up in a final piece of goods. So we want to keep this short as well. We don't want to be holding stock for ages. We'll have a chat about what are some of the problems with holding stock for too long. So our stock per our balance sheet divided by our cost of sales multiplied by 365, and that will tell us how long is it taking us to use an item of inventory or stock into a final product that's ready for sale or sold. Okay, so there are two asset ones, our debtors and our creditors. And just keep in mind. Yeah, it's also known as stock turnover. Yeah, so someone just had a question there. Absolutely. It's also known as stock turnover as well. So, or inventory turnover, it can have any of those things. So it's the same thing. Okay. And the last one there coming through, our creditors credit period. So this one is analysing how long is it taking on average for us to pay our suppliers. So we'll see when we come to looking at sources of finance, our small to medium sized enterprises really rely heavily on trade credit, i.e. being able to purchase goods today and bring them home and use them in their business and not pay for them for a number of days. Okay, so interestingly, the whole thing with credit arose hundreds of years ago when the majority of, I suppose, economic trade was to do with food and farming and agriculture. And typically there will be periods of time the farmers will be very flush with cash because their stock or their vegetation would have been harvested and ready for sale. And then times of the year where they had no money, where they had maybe just sowed the field and they'd have to wait so many months for the items to grow. So the idea of credit came around in that people knew that by the time the crop would come in, that the farmers would have the cash to pay for X, Y, and Z. So that's how it kind of came about. We'll give you a kind of time to pay until your crop comes in and you sell it. And our modern day version being our trade credit. Really, really important if we do get credit days from our supplier, what we can do is use the money that we would have otherwise paid them straight away. We can use it elsewhere in our business. So try and kind of keep the wheels turning. Again, we're going to be using our creditors. And if you want to just highlight there, it's our trade creditors only we're interested. Okay, so if we have a bank overdraft, we're going to ignore that. If it's still a creditor, but it's not a trade creditor. If we've declared dividends and we haven't paid them to shareholders, we're going to ignore that. We just want to look at those trade creditors, people we have purchased services or goods from for direct use in our business, on which we still have to pay them. Okay, so trade creditors, and divided by credit purchases. Now, the thing about credit purchases is we are not always going to have sight of what credit purchases are in our accounts. Our credit purchases typically are buried up in our cost of sales. So what did we purchase on credit that relate directly to the sales of our goods? Okay, so if you want to just put an asterisk there beside credit purchases and say, if I haven't been given this figure, I can use cost of sales instead. Okay, so credit purchases, in many companies, the cost of sales will be the same figure as credit purchases. But in cost of sales, we can also have things like depreciation, parts of labor, and other kind of costs that relate to the goods plugged up there, which aren't trade credit items or purchases as per se. So that's just one to watch. So I have a question here. What about normal purchases instead of cost of sales? So I'm not sure about that question. If we have that information, we'll see in some of our questions we'll be told credit purchases. But we just mightn't be able to glean that. If when we look at question 12, it might make a bit more sense why we can't actually see what the purchases are. Okay, so we'll see between the questions. Okay, so all going well. I'm hoping this works. I'm going to just share a little video about how these three come together when we're looking at our working capital cycle. I'm just going to stop sharing that for a minute. And if you could just let me know that when it plays, that you can hear it, that would be great. It's not that one. Okay, so I'm going to share this to you now and hopefully it'll work.
Hey everyone, just going to have a look now at the cash operating cycle, or the working capital cycle as it's often called. Okay, really quickly then, what happens is, obviously we go and buy something, okay? And it takes a little time before we actually sell it. And then it takes a little bit of time before we actually get the cash in, okay? Now, the good news is that when we buy it, it also takes a little time before we have to pay the cash out, because we get things on credit just like we give credit. But just look at that diagram now. See, the cash in comes later than the cash out. And we call that period there the operating cycle, the cash operating cycle, the working capital cycle. It's the difference between when you get your cash in for goods compared to when you get your cash out. Okay, and you want that to be as short as possible. You want it to be negative, get your cash in before your cash comes out. But often it's a positive figure where you have to pay cash out before you can pay the cash, get the cash coming in. Now, obviously, when you're making profits, the cash coming in will be higher than the cash going out, but still, there's a period of time when you don't have that money. Okay, let's have a look at the diagram in a bit more detail. When we buy something and we keep it for a while before we sell it, well, that's in stock, isn't it? It's in inventory. So we can say, well, how many days is it in inventory? And you'll see inventory days as a ratio a bit later on in the course. And then once we've sold it, it takes a while to get the cash in. So therefore, it's in debtors, it's in receivables. So we call that, we can have a look at a ratio called debtor days or receivable days. And similarly, when we buy something, before we have to pay the cash out, well, that's our payable days. And so even though we'll look at those ratios later, you can see that there's actually a nice little formula for us to calculate the operating cycle. It's how long it's in stock for, the inventory days, plus how long it's in debtors for, the debtor days, minus how long it's in creditors for, the payable days, and that will actually calculate your operating cycle. Okay, now you want that operating cycle to be as small as possible because that operating cycle needs funding, as you'll see in the next section of the course.
Okay, so that's just a little reminder of how those three work together. We typically try and keep, as it was said there in the video, that operating cycle as short as possible because we're having to fund that activity in the meantime, and we look at how we do that. If we think about the diagram there, about the difference in timing between we have our inventory and then we have a good that we sell and we're waiting for the cash to come in, and then in that particular example, there was a time delay between we had to pay our suppliers before we were going to get the cash in from the customer. Can we think of a company or a business in another industry where we might have a different scenario where we might receive the cash from our customers before we have to pay our suppliers? I'm thinking of one or two different industries. So where would we have maybe a negative operating cycle where we're getting cash in from our customers before we have to pay our suppliers? Any examples that we can think of if you want to type into the chat? So a negative operating cycle. So money coming in from our customers before we have to pay our suppliers. Okay, so some examples coming in here. So we have a furniture shop as an example. And yes, in a sense, that could be the case if it's a furniture shop that's selling to non-business customers like yourself or myself. Typically, we have to pay upfront before those items are delivered to our house. And then typically they might have trade credit period. So depending on how long they're holding the stock for, maybe potentially. Any other examples? If we think about, I mentioned one maybe at the start of the lecture that will have this scenario. The kind of most common one we come across. Yeah, exactly, Nicola. So our groceries and our supermarkets, they're in a great position. So if you think about Tesco's have a huge buying power, huge negotiating power. We say typically 30 days is the standard trade credit in Ireland. But we'll see as we go on, if we're doing more business with someone or we're purchasing large volumes from them, we might be able to negotiate more favourable terms. So, but we'll say, for example, our Tesco's negotiates 30 days credit. They buy in then the fruit and veg, which typically won't stay in inventory very long. It'll be put out on the shelves, and then myself and yourself go in and do our local shopping, and we pay over the cash straight away. So maybe potentially within 7 days, the stock has gone from inventory and it's been converted to cash because we don't have any debtors. There's no time delay to customers going in and handing over the cash. And yet we still have our 30 days running for our supplier. So we still maybe have another 3 weeks before we have to pay our supplier. So we'd operate a negative cash. That's the kind of position we'd love to be in, but it's not going to work for every industry. So yeah, that was the example I was thinking of. Thanks a million for that. Okay, so what we're going to do next is we're going to have a look at those questions, and I'm going to get you to have an attempt at calculating the days. So I'm going to get you guys to have a look. If you don't have the questions in hand, I've stuck that manual in the link. I'm just going to type it in again in case you missed it. Okay, so question 12. I've released a poll there. So I want you to calculate the debtor's credit period, the stock holding period, and the trade creditor's credit period for Dido. So for question 12. Okay, so have a go with them for both years. We'll calculate each year individually. I'm just going to leave back this slide here, okay, so that you have the formulas in front of you. I'm going to be monitoring the chats. I don't have my manual to hand, but it is, let's see, it's section 5.6. So I don't know what page that is, but that's what it looks like on the front. Okay, so I'm going to leave this one here. So I don't have my paper version to hand. Okay, thanks guys. It's 19. So page 19 in your hard copy manual. The ratios themselves are on page 16 or so. Okay, thanks for that, guys. I'll be monitoring the chats if you have questions. Okay, so have a go, and I'll keep an eye on the poll. Once we get up to about 70% of the class have answered, we'll move on. We'll have a look at the solution. Okay, if you're not sure some of the parts, just type me in the chat. If you could just type to everyone in the meeting, that'd be great. Thank you. Okay, so remember some of the substitutes we're going to make. Okay, so is everybody sure what they're supposed to do? If not, just give me a shout. Okay, so for anyone not sure, this question is on page 19, and what I want you to do is calculate the debtor's credit period, the stock holding period, and the creditor's credit period for both 2018 and 2019 for Dido, and just respond to the poll. Okay, any questions? I'm monitoring the chat here. If you want to type in if you're not sure what figures to use, etc. Okay, so I see some votes coming in, which is great. So all three questions. Okay, and if you're not sure, just let me know in the chats. I'm keeping an eye on them. Okay, if you're not sure on anything, again, we're going to just be using our balance sheet or our statement of financial figures for the debtors, the stock, the creditors. We do not have enough information to work out the averages, so we'll just use the final figure per our balance sheet or our end of year figure per our balance sheet. Also watching for our creditors' credit period. We haven't been given credit purchases in our information that's been provided. So as a substitute, we can use cost of sales where we haven't been given that information. Okay, so I'm going to let it run for a few minutes. I'll be keeping an eye on the chats. About 20% of the class have answered or responded so far. We've a couple of different figures coming in, so we'll that's okay. We'll spend time going through each. Okay, if you're not sure on anything, just send me a message. Okay, and this is what the question looks like within your Moodle. So I know it's probably a little bit hard to see in a computer. You're scrolling up and scrolling down. Instead of those average figures that we've seen there, we're just going to be taking the final figure per our statement of financial position. So that's what I mean when I say by this. So for 2019, our debtors figure is 10 million. 10 million is owed to us. So watching the donation up here, millions. In 2018, then our figure for debtors we'll use is our 6 million. Okay, so that's where we'll find that information and other information as we go. Okay, so I've nearly half the class have answered, so I'm going to give it another minute or so. If you have the answers done and you're looking at, I want you to have to think about what is this telling us about this company? Is this company healthy when it comes to looking at these three working capital ratios? Are they adequately managing their working capital, or do we think they could do a little better in certain areas? So if we have our answers, have a think about that. Is their position disimproving from 2018? Or maybe we're not concerned with any of these answers that we've been given. It's okay. So again, if you're not sure, have any questions, just type into the chat. If you're thinking it, someone else might be thinking it too. Okay, so I'm going to give it another 30 seconds and then I'm going to end the poll. So if you want to submit your final results there, if you didn't get a chance to finish all three, that's okay. You'll have a longer time in a normal situation. I'm just conscious of what we have to cover today. So I'm going to end the poll now in the next kind of 10 seconds. And you won't be able to vote after that. So I'm going to end the poll and I'm going to share back the results and then we're going to go through each one. There's a consensus coming for most of the results. That's good. Again, using these polls, this isn't a way me trying to trick you out. This is just so I can gauge how we're traveling or how we're doing with the material. So I'm just going to end that now. I've only half the class have answered, so if you didn't get a chance, that's fine. I'm going to end it and I'm going to share back the results. Okay, so hopefully you can see those results there now. So we have a bit of a varying answers for our debtors credit period for Dido. So I'm going to start getting ready to calculate my amounts, so my debtors days. So there's a consensus coming for 126 days and 104. So I'm just going to stop sharing those results for a minute and I'm going to go to my notebook here. So what are we trying to measure when it comes to Dido? So we want to know, on average, when we look at all of our customers, how long is it taking our customers to pay? Now, obviously, what you'd say to me is, well, can we not just look at each customer individually? And absolutely, we can do that. Just trying to make that as clear as possible. We absolutely can do that and see who are the kind of troublesome customers. But this is just a snapshot view if we're looking at our working capital efficiencies, our working capital efficiency. So how long it's on average it's taken our customers to pay us. Okay, I'm just going to turn off that light, I think. Just bear with me 1 second. I'm just going to turn it off or turn down the blind. Okay, that's a little bit clearer. Sorry about that now. Okay, so we are going to look at it for both years. So with most of our ratios, again, we want to look at what's happening with trends over the 2 years. And where are we going to get the information? So we're looking for our debtors. We don't have enough information for average debtors, and we are looking for our sales. So I'm just going to jump back to the question quickly. Again, if you have questions as I'm doing this, type them into the chat and I'll try and keep an eye on that as best I can. So our sales or sales revenue, again, we're going to assume, we haven't been told otherwise, where we're going to assume that this sales revenue, we've 29 million in 2019 and we've 21 million in 2018. We're going to assume that they're all on credit. We haven't been told otherwise. Okay, scrolling down then, where will we get our debtors figure? So our debtors figure sitting in our current assets. Again, money that's due into us. That's where we get our debtors figures for both years. We're going to calculate these separately. Okay, so 10 million in 2019 and 6 million in 2018. So we have enough information to calculate this. So thankfully, we picked one of the options that had that. So we have our 10 million, our debtors owed to us in 2019, and we had 29 million in sales. Okay, so at the end of the year, to annualize that then, on average, how long it's taken our customers to pay us. So whoever had correctly said that in 2019 it was taking 126 days, absolutely right. Our debtors that we've taken from our balance sheet, our sales. For 2018, we'll do the exact same thing. Our debtors were much lower, 4 million euro lower. And that might be reflected if we look at what's happening with our sales. So our sales jumped massively. Okay. When we see our debtors figure at the end of the year, maybe there's a couple of things we could think about if it's jumped so much. When we're taking on new customers, are we doing the checks? You know, we want to be careful about how high we let our debtors grow. We need to offer credit so that we can boost our revenues and our sales, but we need to also manage that. So what did we say, or what are some comments we could make based on these results? In 2018, it was taking on average 104 days for our customers to pay us. And now it's taken, in 2019, it's taken 126. So what could we kind of say about the company based on that result? Is it doing better? Is it doing worse in terms of collecting cash? Would we be concerned about those numbers in any sense for both years if we consider that the average trade credit period in Ireland is 30 days? So what kind of could we say about that? If you want to type into the chat any comments that you made, if you had your results done maybe a while before the poll ended. Okay, so I think the answer is yes, you would be very concerned. So when we look at this 104 days, if we took a typical 30-day trade credit, this is way, way above. It's taking way longer. And the longer this takes, the more we have to find money elsewhere to fund our activities, to buy stock, to have cash to pay our creditors. It's getting worse. Our position is worsening. It's lengthening out our days. Okay, so if you go back to that diagram in our video, 126 days before we get the cash in, that's going to put us under strain. Okay, so the second one that we had to have a look at was our stock holding period. And what we're going to look for is our stock divided by our cost of sales multiplied by 365 days. Our answer is always in days, not percentages, not anything else. And it's on average, how long are we holding items in inventory? How long are we holding items in inventory? Now, this one as well, we like to get as close to zero as possible. But if we think about production processes, if we think about manufacturing process or the nature, particularly in Ireland, where we acquire so many items from the EU and outside the EU and the time that they take to get to us, it's not always practical to have a zero inventory days because we might have to have stock build up and waiting for us. So again, it's not always practical. We have to think about the type of business that we're operating in. So where do I get these figures? Again, our cost of sales, I'm going to find in my income statement. So I'm in my income statement, all my revenue, all my expenses, and my cost of sales directly attributable are posted here. So I'm going to be using my 17 million in 2019, my 10.6 in 2018. I'm just going to share the poll back just to have a look. We had very different answers coming in, a couple of different answers. There was a consensus for 201 days and 103 days, which is correct. So we'll have a look at the other ones, maybe what we might have missed with votes coming in for some of those other ones. Okay, so we'll have a look at what happened. So our stock, again, we can see even visually, we've 6.3 million more invested in stock at the end of this year. So maybe that's reflective of we purchased loads of stock in, but we weren't able to sell it as quickly as we thought, or maybe we're buying up stock so that we have it for the following year. So again, we're going to look at the 2 years. If you've already this done, have a think about what the results tell you. Are we a bit concerned? Again, so our 9.35 million in stock at the end of December 19, and our cost of sales, 17 million. So in 2019, it was taking us 201 days holding an item in stock. Okay, significantly high. I'm going to get you to think about what are some of the problems of holding stock that long. So we have 3 million in stock. Much less was held at the year end the previous year. Maybe we had better controls over our stock. And we had 10.6 million. And we'll see that still wasn't overly healthy, but in 2018 it was 103 days. So I want you to have a think about and type into the chat, what are some of the problems with holding our stock for really long periods of time? What problems might we come into? If we're holding stock for nearly 3/4 of the year, what kind of problems potentially might we be exposed to? Okay, so you can either type your suggestions in the chat, or if you want to jump in over the microphone. Yeah, brilliant, Owen. So the very first one there we have, thanks Owen for that, storage cost. Yeah, so some of the problems we have, storage being a massive one. Okay. Also with storage, we're going to have insurance costs. We're going to have to insure that stock. That's a lot of money tied up. So we're going to have storage, insurance, any of that additional cost, rent, etc. All of that stuff. Power and heat, if it's a typical amount. Absolutely, Nicola and Louise. Expiry dates, or they become invalid. So obsolescence costs. This is huge. So again, I use the example, if I have a warehouse of iPhones, the last version, I could have hundreds of €1,000 worth of stock in iPhones, and then a new one comes out, and straight away, either my iPhone is obsolete or it's now being devalued in the marketplace because there's a newer piece of technology. So I'm going to lose out. There's going to be a huge dip in costs. What else did I want to say about holding these too long? They're the two main things we'll have costs. Oh yeah, of course, the most important one. Our cash is tied up in our stock. Okay, so yeah, exactly, Nicola. The longer that we have it, if there's a warehouse of iPhones sitting, they're very vulnerable. So we might be at risk of theft or damage as well, which we'll lose through other costs as well. Yeah, great suggestion. Okay. But if we're trying to manage our cash effectively, here and now at the end of the year, they've 9.35 million tied up in their items that they sell. Can't remember what this company does, but that's what they've tied up. That money could be used elsewhere within the business. And when we look at some of the other ratios, maybe the fact that they've purchased so much stock, they're putting pressure on themselves in terms of repayment. So thanks for all those suggestions there about the problems at holding stocks. I suppose one of the advantages if we hold stocks, and why sometimes we hold more stock than we need to, is that we reduce the case that we might, I'm just going to say, stock out. Okay, so we reduce the case that we might have a stock out. So say, for example, we hold a particular product. We didn't order in as many as we thought we needed. Our customers have bought our full stock, and then customers are still demanding more, and they decide to go to our competitor. So there we go, we've lost sales. Okay. The second one, again, we're reducing the risk or kind of reliance on suppliers. So take, for example, if our suppliers, we know they have a lead time or a time of delivery of 20 days, well, maybe we know sometimes they deliver on day 20, sometimes maybe they deliver on day 30. We can't be kind of waiting for them because they might get back into this situation where we have a stock out. So reducing that risk that we won't have the stock there when someone wants to buy it effectively, and that we lose out on sales. So we have to weigh that up, and we look in semester 2 at some of the ways we decipher how we calculate how much stock we should hold at one time. There's loads of nice little formulas that we can use. Okay, so great. That was our last. I'm just going to have a quick jump back at the poll and just see how did we get on with our trade creditors days. Okay, so some people answer we cannot calculate with the figures provided, which I can understand why you're thinking that, because we do not have our credit purchase figure. Okay, but when in an exam, if we haven't been given credit purchases, we can use our cost of sales instead. Okay, so use cost of sales where credit purchase figures not available. We've arranged different results there. There's a consensus going there for 90.17 days and 86.8 days. So let's have a look. That is, in fact, the correct answer. So we're going to have a look at that. Again, we're looking at our trade creditors only. So remember, we're going to ignore our bank overdraft. That's not seen. I know it's a trading kind of in transaction, but we're just looking at purchases we've bought, goods and services from people where there's been we have been given credit. Our bank overdraft is a form of credit from the bank, but it's not seen as, it's not within our trade creditors or our dividends owing. So the figure that we're interested in here is our trade creditors, which I've just highlighted there on the screen, and our cost of sales, because we know that our credit purchases are in there somewhere, but we can't tell it anyway. So someone had a question about, could we not just use other purchases? So I'm just showing you there, like we have admin and selling expenses. We don't really know, we don't really know what's in them. So we're just looking for those credit ones. So we can just use cost of sales. Okay, so going back to our, and I'm going to say trade creditors just to make that clear. It's normally our credit purchases. I'm just doing a little asterisk. Okay, because credit purchases, we can use cost of sales instead. Okay, so I'm going to hopefully do it here. So we have 2019 and we have 2018. Again, the standard or typical, the standard typical, I just need to jump back to the question there. What was my trade creditors? Trade creditors was 4.2 million. Okay, and in 2018 it was 2.5. Okay. Sorry now, I'll have my notebook, or I'll have my notes with me next week. It's just hard jumping between the two. So I had 4.2 million in trade creditors, and I'm just going to do the calculation here. 422 divided by 24,950. Divided by my, I'm sorry, I'm going to have to go back here again. My cost of sales, which was 17 million. Yeah. Sorry guys, now that's just because I don't have my notes in front of me, okay? So my 4.2, my trade creditors, my 17 million, which is my cost of sales I'm using instead, multiplied by 365, is telling me that on average, the 90.17 or 18, whatever the case might be, days it was taken on average. So here we see there's strain, okay, if the average kind of time given is our 30 days. The same with 2018. We had 2.5 million in trade creditors, and our credit purchases, we didn't have that information. So we were going to substitute those costs of sales at 10.6. And we can see that our position has disimproved in 2019. Still an area of concern when we think about averages, okay, but we see this increasing out. So when we think back to that diagram that we looked at, the time that we are taking to pay those guys is taking longer when we bring them all together. Okay, how did we get on with those? Does that make sense now when we've seen the results based on what we've versus what we've looked on the polls? Hopefully it does. I'm just kind of conscious of the time. I'm going to leave this up here for the moment, okay, so that you can see it. I'm conscious that we've been on for an hour now, and I'd like to take a 10-15 minute break. So someone remind me that the coffee break. So I'm going to vote for it. Just take a little break, and we'll come back and we will have a look at financial risk and our other two ratios. I'm going to leave this up here. If anyone does have questions on what we've just looked at, I'll be watching the chats. But I'm going to turn off my video and mic just for 15 minutes just to take a break. Back at, it's 4 o'clock now, so 4:15. Okay. I'll leave that up there. Hopefully it's clear enough for you guys to see. I'll be keeping an eye on the chats in the meantime. And when we come back, we'll look at financial risk and gearing. Okay. Okay, so we'll just give it another minute and then we will start back and we'll have a look at the next little part. Okay, so we've just had a look at our working capital efficiency ratios. In semester 2, we look at a lot of the solutions or kind of some of the things we can suggest to companies to try and improve their working capital, because we'll find without cash, a business is going to fail. It doesn't matter how profitable it is. We need the cash to be entering into the business at the right time so that we can pay our bills. Okay, so I'm going to get back started up again. Hopefully you're back with me. And we're going to move on and we're going to look at a measure of financial risk, 2 measures of financial risk that we look at in this course. One being financial gearing, and we'll talk a little bit about that. I think you've come across it before. Sorry, my ears are getting sore with this. And we're also going to look at interest cover. So again, we're trying to assess a company's risk in terms if it has debt or has borrowed. How able is it able to meet the interest repayments on that debt that they've borrowed down? And at what stage should we be worried as either a shareholder or as a potential investor in a company when we view these 2 ratios? So the first one here with our financial gearing, again, like the very first question I asked there, what is a measure of liquidity? Our gearing is a measure of financial risk, along with our interest cover. So our gearing is a measure of financial risk. And all that we're looking at is, if we look at all our total long-term sources of finance in our business, which I'm going to talk about where you find them, what percentage of that is made of debt? And the higher that is, or the higher the percentage of debt that we carry, typically the higher the financial risk that we have. Okay, so the higher the financial risk. And when we talk about financial risk, we're talking about our ability to service those debts. And if something happens our company that it doesn't continue to be successful or performs poorly in a year, are we going to be able to meet those debts? And if we are heavily indebted, we say we have kind of a greater burden or a higher financial risk. So out of interest, have we come across gearing before? If we knew nothing about the company and we didn't know what industry it operated in, what do we consider neutral or neither high nor low as a result of gearing? If we've come across it before, if you want to type into the chats, what's considered kind of not a problem, neutral gearing, neither low but not high, if we didn't know anything about the company or the business that it kind of has in general terms. What's considered kind of neutral gearing? Yeah, brilliant. Thanks, Fiona. So absolutely right, our 50%. So if we knew nothing about the company, we typically say about 50% is considered neutral. And anything higher than that, so 60, 70, 80, whatever the case may be, meaning that over 50% of all our finance is made up of debt. So we're heavily borrowed. It means that it's a higher risk, a higher financial risk. In reality, though, different industries can carry different levels of debt. So an example that I use of if you are in aircraft industry, so you're purchasing Boeings and all these expensive aircrafts. Now we mightn't be deciding to purchase them outright; we might lease them. So aircraft leasing is quite a huge industry in Ireland. But if you think of a business like that that's buying huge assets, it's likely that they don't have the cash reserves to purchase those items on a monthly basis, whatever the case may be. So they probably are going to be more heavily indebted or will have borrowed. We'll look at the different types of debt that they might have. So for an industry like that, it might be able to hold a higher risk versus maybe our supermarkets. They're going to have pretty much a lower gearing in that we already said earlier on that they don't really have a problem in terms of their operating cycle. They get that cash in before they have to pay their bills. And although margins are small in terms of the profit that they make, perhaps they don't have to borrow as much to keep their activities running as a result. So it could hold a lower sector average. So we want to keep an eye out on those business sector averages. One thing to mark for yourself, anytime you're told anything about a business sector average in an exam, you are required to comment on it, and there's marks going for making a correct comment about how the company's doing compared to the business sector average. Okay. As Fiona correctly said, the 50%. So lower than that, lower risk, higher than that, higher risk. Okay, so the two formulas that we're going to have a look at. So I'm going to talk through these two, and then I'm going to get you to calculate them on Dido. We'll use another poll. So the first off, we're going to need our profit before interest and tax. So what's that also known as? Our profit before interest and tax. What's that also known as in our accounts? So sometimes it's called something else in our accounts. Our profit before interest and tax. Yeah, brilliant. Thanks, Shauna. So our operating profit. So again, if you want to substitute that in for yourself there, our profit before interest and tax have been taken away, or our operating profit divided by our interest payable. So our interest payable is going to be the interest amount that is posted to our income statement, our charge of interest for the year. Okay. Anytime that we see cover as a ratio, it indicates that the answer is in times. So how many times our interest cover is effectively telling us how many times could I have paid this interest out of my operating profit? We will come on to look at dividend cover. Our dividend cover will tell us how many times could I have paid this dividend out of my operating profit. So that's what our answer is telling us, how many times. We typically say that an answer of 3 times or higher we're happy enough with. So as low as 3, anything lower than that, if our company or our profits are hit by an unexpected economic shock in the following year, we're going to get into difficulty paying down our debts, and we'll come into what issues we might have there. Okay, so our operating profit divided by our interest, and we'll find that in our income statement. Okay. Secondly, then we have our financial gearing. Right. So there's 2 things I need to clarify with this formula. So the formula itself is long-term debt. So if you want to just draw a line out from your long-term debt in your notes, you're going to find long-term debt in non-current assets or non-current liabilities on your statement of financial position. So non-current liabilities. And debt can look like a number of things. Okay, so long-term debt, your non-current liabilities in your balance sheet. Okay, and debt can look like a long-term loan, a long-term debenture, a loan note, a bond note that's not due for payment basis of long term. So if it's in non-current assets and it's any type of borrowings, non-current liabilities, I keep saying assets, non-current liabilities, it's borrowings, we need to consider it here. Now, within that formula also, we have to consider preference shares. So I believe we talked, or if I remember rightly, we talked about these preference shareholders, these guys last week. So what's significant about preference shareholders is that they have no voting control in a company. They are entitled to a fixed dividend every year, unlike our ordinary shareholders who may or may not receive a dividend depending on how the company does. So for that reason, preference shareholders are treated almost like akin to a lender and a debt type arrangement. So I want to clarify all the questions that we look at for financial gearing. There are no preference shareholders. So we don't really need to worry about it in terms about it. So all questions that we look at on your course for financial gearing, we do not have preference shareholders. Okay, if we did, it'd be visible on our balance sheet. We'd see it split out as a separate investment or a separate amount of money coming in. Okay, so that's our long-term debt and our total long-term finance. Okay, so how we calculate our total long-term finance is our total long-term debt that we've identified above, and preference shares if we have them, but all the questions we look at do not have preference shares. So our total long-term debt plus our equity. Okay, so I'm just going to type this into the chats as well so that we have it when we go to look at the question. Total long-term finance equals total long-term debt plus equity. And then I'm going to jump to show us what or where we find our equity. Okay, so long-term debt. So I'm going to jump back to our question. I'm going to show you where we're going to find our total long-term finance, our total long-term debt plus our equity. And then I'm going to get you to have a go at this question. Okay, so I'm jumping back to the notes. Thought I had them open. Okay, so I have my income statement. So I'm going to be looking here and here for my interest payable and my operating profit for my interest cover figure, my income statement. And for my gearing, then I'm going down to the balance sheet. So I need to look in non-current liabilities. Is there any debt? Is there any loans? What do we have? So our long-term loan is the same as long-term debt in this scenario. Okay, long-term loan. There's our long-term debt. 2.5 million we've borrowed and we owe back. And our equity then is made up of our ordinary shares. So the original ordinary shareholders who paid up 25 cents per share in the company. There's 5 million in capital raised there from their initial subscription to the shares. And our retained profits. So the rolled up profits that we have retained in the business. Okay, so our equity then is this figure here, 22,450,000. So this mightn't always be displayed like this. So we're going to need to know our equity is ordinary shares and retained profits. Okay, and your long-term debt, then you're going to add to that to get your total long-term finance. Okay, so I'm going to jump back to the formula slides. I'm going to open up the poll to give you a go at calculating the interest cover and the gearing for Dido. I'm going to keep an eye on the chats if anyone has questions when they're looking at it. Okay, so I want you to calculate the interest cover for both years. And vote in the poll. So I'll keep an eye on that. Once about 60 or 70% of the class have answered, we will have a look at the solution. So I'll be keeping an eye out on the chats. For any questions anyone might have. So you can send them to me privately if you'd like, if you don't feel comfortable sharing with the group. Otherwise, I'll just keep an eye on that. Okay, so I'm going to turn off my video now for a minute and give you guys a chance to read that and attempt it. Hi, Sean. Yeah, I will be making available the solutions to the questions that we're doing in class. I'll put up the typed versions rather than my scrolls. I will be putting them up on Moodle. I'll try and do it this week. Typically, I release them all at the end of the topic. I'll be putting them up on Moodle. Okay, so I'm just keeping an eye on chats. If anybody has any questions on what the figures and stuff, just let me know. I'm keeping an eye on them. Okay. We have a couple of people who voted already, so just give you a chance. Okay, so about 20% of the class have answered. So if it's a case you have the calculations done already, it's not a problem if you don't. Have a think about what the state of the company is based on the calculations that you've just done. So what can you infer from the results? Okay, so great. Varying different answers coming in, so we'll have a look and we'll step out where these solutions came from. So I'll just give you another minute or two, and then we'll have a look at the solution. Again, if you want to ask me questions, just type into the chat. I'm keeping an eye on them there, so feel free to ask me a question. Okay, so I'm just conscious of the time as well. So I'm just gonna give it another minute. I've about half the class have responded so far. Okay, so we've varying different answers coming in. So hopefully when we go through the answers, it'll make it clear what we were looking for. So I'm just gonna give it another minute, and then if you didn't get a chance to do it by by the time I close it, don't worry, that's not a problem. And just in the interest of time, what we have today, and going through the solution. I'm just going to keep it open there for another minute and then we'll have a look at the results. Okay, again, these are great little practice ones in terms of getting used to answering multiple choice questions for the CA. Okay, so I'm just going to close the poll. If you didn't have a chance to get finished, that's fine. Don't worry. I'm just going to close it now and end the polling, so you'll no longer be able to vote. But what I'll do is I'll close it. Only about half the class got a chance to attempt it, so don't worry if you didn't get a chance. I'm going to end the polling now and just share our results, and let's have a look at what we think. Maybe we weren't sure. Maybe this is one of the ones we weren't a little bit sure. There's different answering coming in. Okay, so I'm going to share the results back with you guys. So our interest cover, so we were trying to see with Dido, how many times could they have serviced or could they have paid their interest out of their operating profit? We typically are looking for an answer of at least 3. And any higher than that, we know the higher it is in terms of risk, we know the lower the risk is. So we'll see in terms of financial risk how Dido is doing. Okay, so we have a consensus there for the second answer, 39.2 times in 2019 and 44 times in 2018, which is absolutely correct. So I'm going to stop sharing these results just for one moment, and I'm going to jump to my page and let's step out how we did this. Okay, so how did we calculate this? So again, we're trying to see how many times we could have paid our bills, so our interest cover. And again, it's good practice. You don't get these formulas in your exams. So again, our profit before interest and tax, or also known as operating profit, I'm going to stick up here, divided by my interest payable, and that's going to tell me how many times I could have, or how the company could have paid the interest. So we have 2 years that we're going to look at, 2019 and 2018. So in 2019, our operating profit, I'll do 2018 first. Our operating profit in 2018 was 8.8 million. Okay, so our 8.8 million, our operating profit. And our interest payable in that year, based on the loans that we had, was 200,000. Okay, so 8.8 divided by 200,000 gives us a result, absolutely correct, of 44 times. So what that's saying is Dido could have covered their interest bill 44 times out of their current level of operating profit. So we know that if this company doesn't do as well as it did in 2018 and its profits decrease, and our debt interest level stays the same, we're very healthy. It's very low financial risk. Okay, so there's a low financial risk there. Okay, what was happening in 2019? So our operating profits increased to 9.8, if I'm correct. And we obviously took on some further borrowings because our interest bill increased to 250,000. But we're not really that concerned. So when we look at that, that tells us that 39.2 times. Again, it's still very low financial risk. I'm just going to go financial risk. Okay, 3 or above would have been kind of healthy enough. So this might be something that we look at if we are deciding to take out more loans or any items that have interest attached. Well, we're very healthy. We can sustain more interest repayments if our profits dip. Okay, so I'm going to share back those results. So if you had no, Lauren, these formulas aren't given in the exam. So these are ones that we have to learn off. So Paul's will stick up a sheet of what you actually physically get in the exam. But for any of my formulas, these are ones you have to learn off. Okay, so that's why I spent was a good bit of time looking at them. You won't be getting them in the exam. So that's our interest cover. So hopefully for those who looked at some of the other answers there, that makes a little bit more sense now where we're getting the 39.2 and the 44. Okay, now our gearing. So our gearing, we have a couple of different answers. So cannot answer based on the information given. So we can identify what total long-term finance is, and we do know what our long-term debt is. No problem, Lauren. Sorry, just keep an eye on that as well. And we have varying different treatments of the gearing. Now, one of the things that I put in there, I think from memory, is you might have come across a previous gearing ratio which is absolutely correct as well, but it's not the one that we look at on our course. So the previous one is you're just looking at debt as a measure to equity. So you're looking at the kind of comparison of debt to equity. Okay, the formula that we use, and you'll see in the question, I've even indicated using long-term debt divided by total long-term finance. That is what is examinable on this course. So just watch for continuous assessment questions. It's your total long-term debt divided by your long-term finance, not your debt to equity, which is another gearing ratio that you would have learned in previous classes. Okay, so I just want to clarify that because there has been confusion over that in previous classes, and you'll see I've put in a kind of a dummy question to lead you down that path. Okay, so sometimes the multiple choice questions aren't nice like that. They will have the wrong answer in there. Okay, so I'm going to stop sharing these results, and before I go on to this, I'm going to jump back to my accounts, and I'm going to be concerned with the second half of my accounts. And what I'm looking for is my long-term debt or my long-term loan. There are no preference shareholders in this example. How do we know that? Because when we look at our equity, all we have is ordinary shareholders. Okay, so there's nothing mentioned about preference shareholders anywhere. In addition, when we look up here, there's just ordinary dividends paid. If we had a preference shareholder, there would be a preference dividend paid before then. Sorry, now I see something. Yeah, the MCQ typically is going to be in week 5. Myself and Paul are going to be chatting about that tomorrow. So we'll it's in week 5 of your course. So we'll be getting in touch with you about when that's going to be. Our non-current liabilities then we have here, and we have our equity. So our total long-term finance is the total of our long-term debt plus our ordinary shares plus our retained profits. Okay, I'll just do that again. Our long-term debt, our long-term loan, it could be bonds, it could be debentures, it could be loan notes, plus our equity, our ordinary shares, our retained profits. Okay, so I'm going to jump back here. We have our long-term debts. I'm just writing out the whole formula so that it's correct. We know that there are none in this particular example, long-term debt. And then our long-term debt plus equity, which is also known as our total long-term finance multiplied by 100. Sorry, multiplied by 100 to give us a percentage. Okay, so this is also known as total long-term finance. What this is telling us is out of our total finance, what percentage is debt. The higher that being, the higher the financial risk. Okay, so if we look at 2019 and 2018, our debt or our long-term loans were the exact same amount in each year. So our long-term debt was 2.5 million in both years, 2.5 million. So we're going to have our long-term debt, there's no preference shares, over our long-term debt plus equity. So our long-term debt plus our equity. So I'm going to just jump back to my question because I don't have the answer in front of me. My equity is 22,450,000. I'm just going to write this down here for 2019, and it's 17.4 million in 2018. Okay, so this is what my equity is in either year. We'll look at different ways that this can be displayed. So you need to identify that your equity is your ordinary shares. Okay, so that's your ordinary shares plus retained profits in this particular question. Okay, and this is our long-term debt. Okay, multiply by 100%, and we'll see with these with this company, it has very, very low financial risk. Less, only 10% of its total finance is made up of debt. Okay, so the majority of the finance is coming from equity sources, ordinary shares which shareholders subscribe to, and retained profits, so rolled up profits that we had. So in this case, again, it's low risk. We don't know anything about the industry average, but without knowing anything, 50%, up to 50% would have been considered neutral. The same with 2018. We have our 2.5 million. So our long-term debt will do on the bottom line as well, plus our equity, which in 2018 was 17.4 million. Our ordinary shares, our retained profit, multiplied by 100. That's our total long-term finance, the two of them together, which gives us 12.56%. Okay, again, so we actually see our position improved. Our position improved, our gearing actually reduced, so our risk, we were even lower risk in 2019. And that's probably due to this equity figure upping. I think if we look at the question, our retained profits jumped, and that's what's been reflected there. Okay. So for those of you, I'm just going to share those results again. So for those of you who chose another answer, hopefully that makes it a little bit clearer in terms of where that 10.02 and the 12.56 are coming from. Okay. The 12.56. Okay. Does anybody have any questions on what we looked at there? What I'm going to ask you, sorry, I just see the time now. What I'm going to ask you to do is attempt question 13 in your own time. We won't have time to do it in class. So you'll see that there's the set of ratios and then the analysis. So the start of the next class, I want you to attempt the analysis. The start of the next class, we're going to have a discussion about what the results have actually told us. Okay, so your ratios are all in your manual. You have the e-version of the manual if you don't have your notes. So I want you to attempt question 13 for the next class, and we'll open up with a discussion. I'm going to stay on till the end of the class here. If anybody has any questions that they'd like to ask, you can type into the chat or chat to me over the microphone, whatever the case may be. Otherwise, thank you very much for joining me today. Thanks to everybody who contributed in the chat, and for those of you who turned on your cameras. It really makes my job a whole lot easier when that happens. So thank you very much. I'm going to stay on until 5 if it is a case that you have any questions. Otherwise, you're free to go and enjoy your evening. Again, so some of the questions, I'll be putting up the solutions shortly. I typically do it at the end of the chat, and I'll be getting on to you about the MCQ soon as well. So no problem. Thanks. Thanks, Mia. That's okay. I know some people, the internet isn't great, and I'm sure it's terrible listening to me on a jolty connection, so that's no problem. If you have any questions, just let me know. That's no problem, Fiona. Okay, so you're free to go, but if anyone does have questions, I'll be here for the next 10 minutes in cyberspace. Okay, so does anybody that's left on the line, do you have any questions or? Yeah, no problem, Robert. Thank you. Hi, I'm not sure. Is someone trying to come in? Hi, Adrian.
How are you doing? Sorry.
How are you getting on?
Yeah, sorry. In the what is it? The stock holding period.
Yeah.
What was it? Yeah, you get like 9,350.
Yeah.
Yeah. Do you divide it by 17 or?
Yeah. So I can jump back to that one there that you're talking about. So for Dido, so what we're looking at is the 9.3 million in stock,
Yeah,
and we're dividing it by the 17 million, which is our cost of sales.
9.3 was it? There wasn't 9,350, no. That's what we have.
Well, so yeah, so the 9350. If you know on the accounts, these are all these figures are in millions.
Okay.
Okay, so I've just displayed them like the accounts, so to kind of show you where the figures are coming from.
Yeah.
So then,
but say, like, do I divide that by 17?
yeah, exactly. So you take 9350 divide by 17.
Right, and then I press equals minus or multiply by 365.
Exactly.
Equals multiply by 365. Yeah, and in my calculator I get 803 over 4, so that's why I'm a bit confused.
Okay. So your calculator is showing you a fraction.
Yeah.
I've seen that on a couple of calculators. I'm not sure what the function is to change that back to a number. My calculator just does a number that's showing it as a fraction. So you need to click a setting on your calculator so that's not showing the figure as a fraction.
And all I can seem to get into is 4 different ones: calculator, statistics, table, or ratio. So
it should be calculator, just the normal.
yeah, no, I'll have to
That's-
ask someone that knows about them and have a look at it, because my answers have been funny all day, and that's why I'm
Yeah.
lost. I'm trying to figure out what's going wrong.
Okay, so that's what it is. My calculator doesn't do that. So it's whatever brand. You just need to fiddle around with it. It should be 200 and point something, so close to 201 days. It's just a setting on your calculator. You're doing the calculations right. It's just to change that setting.
Yeah, no, I'm taking down all the questions and the answers, so I have material in front of me. It's just the calculator's wrong, so
yes.
I'm just wondering, you know what I mean?
Yeah, I know you're wondering where it's coming from. So maybe I can have if you want to have a chat to maybe someone. I've seen people in the class with those calculators. It's just mine doesn't do that, so I can't really advise you on what the button is to press to change it back just to numbers.
Yeah, no hassle. Cheers. Thank you.
Okay, no problem. Thanks, Adrian.
Thank you.
Okay. So what I'm going to do now, guys, if nobody else has any questions, I'm going to end the meeting. I'm going to stop the meeting, and I will look forward to seeing you at the next class. Okay, thank you.